Good morning, everybody. Welcome to With the Brokers Live Daily Market Outlook for Monday, 18th of February 2012. The day's post G20 meeting did not produce much of the expectations, basically, about the increased signals of the currency war that is developing now between the big countries. As G20 officials promised, unlikely to end the devaluation debate, as we said, the financial leaders from the world's 20 biggest economies might have promised not to devalue their currencies to help exports, but the pledge will do little to keep exchange rates stable. The best signal for this is a fresh weakness of Japanese yen that is again attacking the upper boundaries, upper targets at 94.40, the recent peaks following last week's weakness that dipped again down to 92.00 seen last Friday, as Japan stays on their course for a further weakening of the yen. While G20 finance ministers and central bank governors can promise not to devalue their currencies directly, there can be no guarantees while central banks are pumping money into economies to make them grow again. The comments from the G20 meeting that ended last Saturday says we will refrain from competitive devaluation. We will not target our exchange rates for competitive purposes. The G20 financial leaders said in a closing statement after a meeting in Moscow on Friday and Saturday. But it's precisely the ultra-loose monetary policy in the U.S. Of the U.S. Federal Reserve of Bank of Japan aimed at helping their domestic economies to grow that depressed the dollar and the yen and sparked the whole competitive devaluation debate. That trend is unlikely to change, something China and other key emerging markets were quick to warn against in Moscow. The Fed's chief Ben Bernanke said on Friday that the United States was using domestic policy tools to advance domestic objectives, and Tokyo in turn insists that the Bank of Japan pledge to start buying unlimited amounts government bonds is purely to help its shrinking economy get out of recession. And the G20 agreed there was nothing wrong with such a policy. So we have to sit and watch to see what will be developments. Of course, quite negative impact still seen in the markets. Recall of Swiss bank that did something 2 years ago, last year, pardon, when they put the limit on further weakening of the Swiss franc at, they put the limit at 120, and so far it worked. Now Bank of Japan is unlikely to, for now, take any step as a new governor is coming as a more aggressive approaching the current problems. With today's holiday, United States, with the U.S. markets being out of play for today due to the President's Day, more action, I would say, will be seen during the European hours, as already acceleration seen on some instrument as Europe started. The euro, briefly, today's calendar, we almost have nothing, so I'm not going to spend much time. Current account from Eurozone is due at 9 o'clock GMT. Forecast is widening of the trade surplus to 15.3 billion euros compared to 14.8 billion euros surplus in month of November. And then speech of ECB President Mario Draghi that is due at 14:30, along with the late in the afternoon monetary policy meeting minutes of Bank of Japan, showing the all from today's economic indicators. So just not to spend more time on this. Let's take a look at the currencies and the commodities. As a quite interesting situation following last Friday's strong action of most of the instruments. Gold dipped nearly 2% and briefly broke below 1600 support, psychological support that now opens a way for some more weakness, and a possible slide towards critical 1520 support. This is in the recent gold weakness was seen also triggered by absence of Chinese market due to Lunar New Year, and simply the technical selling after some important levels were triggered. Then of course the market accelerates on its own. Let's take a look first on the euro and then the other currencies to see where are we standing at the beginning of new week, and what to expect during today's trading. As said, I don't see much of action, especially in the late afternoon, as US will be out of the market, but during the European we still see the quite enough. Single currency remains under pressure, still within the range of 133 approximately on the downside and 134 on the side, with overnight's gap lower opening as the price shows still pressure towards the lower boundaries of the range. The lowest seen at the beginning of Europe is 133.20, just ahead of last Friday's fresh low at 133.05. This was the lowest seen. 133 zone still holds the downside. And the other significant point is doji candle seen last Friday that shows currently the sort of indecision of the markets, possibly for a reversal, as we have a bunch of strong supports. 133 is the first one, which marks 38.2% of 126.60 to 137.10. Then bull trend line of 126.60 through 129.96, currently at around 132.85. And then the also this is the previous 133 is also the previous high of 19th of December. And then we have 132.65. This is January's mid-January's higher platform. Quite a strong support zone at this point within the 50 pips. That shows currently indecision that was signaled by last Friday's doji here, but pressure is still seen towards the downside. If we take a look at the 4-hour indicators, then we'll see that they're all they are in the negative territory and building up the bearish momentum, with the downside, the upside being fairly limited by sending 4-hour 20 days exponential moving average. The highest seen was last Friday at 133.92, holding the initial psychological 134, also 23.6% retracement level intact for now, retracement of 137.10 to 133.05, with more pressure again seen towards the downside following the gap lower opening. As long as we are holding below this gap, then more likely the pressure towards the downside would look for a test of 133 and possible stretch lower. As said, the near-term studies indicators are in the negative territory, and studies maintain a bearish tone that overall keeps the downside more in focus. In case of break 133, the levels mentioned previously will come in focus, 132.85, 132.65, and then break of which is basically seen as a trigger and the break point, as we have the main bull trend line drawn off 120.42. This is the low of July of 2012, posted in July, through 126.60, 129.96, 130.15. Valid trend line currently stands at approximately 132, and then another significant levels 131.85 is the 50% Fibonacci retracement of 126.60 to 137.10, and also it's the previous highs of September 2012 at 131.70. This zone then is seen as a break point that will confirm the reversal of 137.10. So far, initial signals are seen on a break below 133, 132.65, and then comes 131.85, 131.70 seen next. On the upside, 134 now offers good resistance, along with the 23.6% retracement. While a break above here is required to provide near-term relief and signal possible further consolidation, corrective consolidative action, but any break, any lift higher, any extension higher requires again move through 134.37, which is 61.8%, and 130, basically 135 level is seen as the next requirement. We have the previous high at 135.18 posted last week on 13th of February, and 135.08 50% retracement. So anything above 135 would confirm the bottom and the base at 133.805 and the open way for a possible fresh extension towards the upper boundaries. Otherwise, range above 133 could be consolidation, could be seen as the near-term scenario, with of course a downside being currently more in focus, as long as we are holding below initial now 133.74 20 days exponential moving average, and the 134.00 as the upper boundary of the near-term range. British pound remains under heavy pressure. That proves this morning's fresh weakness that broke below the previous low of last Friday at 154.59, 154.37 seen so far, and we are en route towards 154, 153.98 next downside targets. The pair remains under the strong pressure since peaking at 163.80 on beginning of the year, 2nd of January's high, and since then it retraced over 76.4. That was the last retracement level at 155.30, and then losing a psychological 155 support that again sees more pressure towards the downside. And basically the focus, near-term focus now comes at, we said initial supports are 154, 153.92. This is the low of July 2012, and then we have the key levels 152.67 low of May 2012, and the 152.33 January 2012. This is yearly low for 2012. And if we take a look at the weekly chart, then we'll see that this is basically the base of the larger longer term range. We have several points here from 152.95, 152.71, 152.33, 152.67. Basically this is the strong support zone, and the signal, the bears signal on the break below the main bull trend line at 157, currently 157.09, better seen on the day monthly chart. This is the bull trend line of low of 2009 at 135.00, signaling that possible fresh weakness and stronger weakness will be seen on a break below the range. This is a longer term range from 2010, and these levels are seen as the base of the range floor of the range, break of which could trigger some more significant weakness of the British pound against the US dollar. Back to the near term, immediate resistance comes on the overnight high at approximately 155, where is the 20 days exponential moving average. Then last Friday's highs 155.40, 155.49. That also marks approximately, I would say, 50%, since the market moved there when around close to 50% of the recent downleg from 156.88, but since we don't have clear bottom, we cannot depend on this. But in any case, holding below 156, I would say, would keep the immediate focus towards the downside. Only break above 156, possibly 156.88 recent peak is set to provide relief and signal near-term base. Otherwise, downside remains in focus, as we can see from the previous movements. Brief correction follows the fresh extension lower, but a steady downtrend since from 163.80 that accelerated on the break of some important points remains fully in play, and the most likely near-term scenario would be extension down towards the very strong and important support at 152.67, 152.33. Dollar yen, as said, remains stronger again. The strength after last Friday's dip to 92.21. This is the near-term range floor. As we can see, 92 zone offers quite good support. We had 3 attempts at these points being contained here, and this is also 38.2% Fibonacci retracement of upleg from 88.05 to 94.45, with the later coming now in the near-term focus after acceleration seen on the last Friday from comments from G20 brought and the Bank of Japan officials brought the pair to the levels above 94 psychological barrier. That opens way towards our in recent peaks at 94.40 and 94.45 for possible resumption of the broader uptrend, and the focus that focuses 94.97. This is the high of May 2012. Currently, the pair already retraced 38.2% of the longer-term descent from 2007, 124.14 to the record low of Japanese yen at record low of dollar yen at 75.55 posted in 2011, and the strong recovery from the higher base at 77 zone September 2012 low still shows no signals of giving up. Basically, this current trading since beginning of February is seen as consolidation with no any signal on the downside break, but on contrary, more focus is again shifted towards the upside. Of course, we need to see the break above 94.40-45 in order to resume the uptrend, with the near-term structure being positive. As we can see, fresh momentum building up on the 4-hour chart sees room for a possible retest of 94.40-45 and break higher. Hourly studies are slightly extended at this point, yet no reversal signals, so basically the upside remains in focus. Immediate support where the 10 days moving average contained the recent overnight dip, it's 93.80, and then we have the day's low at 93.64 seen as initial supports. Hold above the gap is another supportive element. 93.74, just above this is the 23.6% retracement and the 20 days exponential moving average, while I would say any dip below 93.45 and 93.30, which is 38.2% retracement of the uplift from 92.21 to 94.21, 55 days exponential moving average, and the last Friday's intraday low 93.30 seen as ideal point to contain in case of any deeper reversal. Ideally, any dips should be held above this session's low at 93.64 in order to resume towards 94.40-45, and then a possible extension up towards 94.97 2010 peak. And finally, dollar Swiss, a brief extension above past 2 days Thursday Friday congestion top that is approximately 92.44. That also marks 61.8% retracement of the down leg from 93.87 to 90.20. Sees potential for a resumption of the uptrend that goes steadily. There are no sudden and strong movements, but we had the first consolidation phase, second consolidation, and third one. It seems to be coming to the end with clear break above 92.50. I would say to open the next significant barrier at 93.00, psychological resistance, and the 76.4% Fibonacci retracement ahead of more significant barriers that are recent two peaks of 7th of December 2012 at 93.81 and 18th of January 2013 at 93.87, the break of which is seen as requirement for some stronger corrective action and extension higher. We better see it on the daily chart. Otherwise, the consolidate further range trading, as basically we are still within the range 93.87-80 and the upside, and the 90.20 levels and the downside are still seen as rather consolidation of the larger down move from 99.70 peak of 2012. Currently, the price action is congested between 90.20 and 94, I would say, roughly. But near-term structure is now more positive and sees more potential towards the upside, as daily indicators are pointing higher and seeing a fresh bullish momentum for a possible extension through 93.00 towards our key resistances at 93.87-81 and 94.00. On the downside, the immediate support, as we said, stands at 92.00. That is this is the base of the recent consolidation. Before this, we have dynamic supports 92.31 20 days exponential moving average and the 92.20 55 days. We're talking about hourly chart. Any slide below 92.00 would increase the downside risk, while a loss of 91.50, that is the recent previous consolidation range floor would weaken the near-term structure and the sideline immediate bulls. Now more interesting, of course, is the yellow metal that suffered significant losses on last Friday's trading. We had a sharp decline from the levels approximately 1630 down to nearly 1598, with quick recovery seen on the last Friday's end of the session, and the overnight trading that peaked at 1618. Overall picture is still very negative. What overextended conditions and test of strong psychological 1600 support might signal some consolidation and delay in the recent down move, as quite a strong slide seen from the upside rejection at 1684. This was at the beginning of month of February, and testing 1600 so far. Basically, we are approaching the very strong and critical support at 1520 zone. This is the multi from 2011, I would say. Several attempts here were contained. We had in 2011, and 2012. This is seen as a trigger. It's also 23.6% of the uplift from approximately 270 to 1920 record high of gold posted in September 2011, and this area basically now comes under increased pressure as the oil slid briefly cracked 1600 as psychological support, that lots of which may open way towards here. We need to see the break below this zone in order to signal some stronger recovery of the past 10 years, a strong rally that commenced somewhere below $300 per ounce and peaked at nearly $2,000 per ounce within a period of 10 years. And technically this is seen as a critical support and the break point. In case we lose 1520, 1500, then a more significant correction could be seen ahead down towards 1300, 1290. That is 38.2% Fibonacci retracement. Now back to the near-term chart. Hourly structure is still overextended, and as we can see, the indicators are pointing higher. That resulted in this corrective action that now faces resistances. The initial one was 20 days exponential moving average at approximately 1618, where initial gains were limited. This is also close to 38.2% retracement of the down leg from 1650 down to 1598. Any stronger move higher requires a regain of 50 and 61.8%, 1624, 1630 levels in order to avert immediate downside risk. But quite a negative tone seen on the larger picture, though we have the oversold conditions even on the daily chart, could be signal for some consolidative action. Back on the 4-hour bounce from here, I would say at this point requires a regain of minimum 1640, 1650 in order to signal near-term base and for possible stronger recovery. Otherwise, anything below this would be seen as another lower top and a fresh extension lower, as the yellow metal remains under heavy pressure in the past couple of weeks. I would say after a couple of 2-3 weeks after losing the initial supports at 1617, then 1650, and finally 1635, 1625, that triggered the fresh weakness down to 1598 so far. Still, I would say at this point focus seen towards the downside, but corrective action cannot be ruled out at this point, as 4-hour indicators are also deeply in the oversold territory. Reversal of stochastic is the initial signal. Now we have to see, as I said, a regain of minimum 1630, 1640 in order to avert immediate downside risk. So far 38.2% retracement seen on the current recovery, but overall negative tone still sees the downside at risk. And finally, the crude oil that again lost traction following a stronger dollar on last Friday's trading, a sharp slide after the price during the week tested the 98 level, briefly broke, failing to regain the recent peaks at 98. Recent peak at 98.22, and subsequent fresh weakness nearly fully retraced rally from 95 to 98.09, bringing again risk towards the downside. For our structure is negative as well as hourly, but overextended hourly conditions signal some consolidation that already showed some bounce of last Friday's low at 95.20 up to 95.99, still holding 96 psychological level intact for now. Again, more focus is seen towards the strong support and base at 95.00. This is seen as a break point, basically, as we had several attempts at this level, and the break here is seen as a trigger for some stronger corrective action. This is approximately 23.6% retracement of the larger 85.20 to 98.22 rally, as the fresh slide shows that the upside levels and recent peaks stay intact for now. I would say more risk again seen towards the lower boundaries and floor of the recent range at 95.00, break of which is seen as a trigger. Holding above 95 would again signal further range trading, as basically as shown on the daily chart. We are still within the range of 95 and then 98.00. With the daily studies now skewed towards the downside, as momentum is already in the negative territory, that increases risk. Of course, the RSI and the MACDs are pointing lower. That increases risk of possible attack at 95 and possible break lower. That may open immediate supports at approximately 94.00, and then we have 93.25 Fibonacci, 38.2% retracement of the uplift from 85.20 to 98.22. Overall, stronger dollar keeps pressure on the near-term oil price, but still break below 95.00 is required to confirm a stronger correction, and open levels on the downside 94 and then 93.25. And that will be all from my side. Please, if there is any question, you can type it and send it to me right now. Okay, seems that we have no questions on Monday. In any case, I don't expect some more spectacular movements today due to the holiday in the United States, but of course European session might still be quite active. Thank you for being with us today, and expect to see you again tomorrow at our regular time, 8 o'clock GMT, 10 o'clock local Cyprus time. Until then, I wish you a nice first day of the new week, and of course good and profitable trading. Good luck.